Jerome Powell's Jackson Hole speech, a high-stakes tightrope walk between politics and economics. What happens when a nation's central bank chief must navigate political pressure, economic uncertainty, and the weight of history, all while speaking to the world's most influential investors and economists? That's exactly the challenge facing Federal Reserve Chair Jerome Powell as he prepares for his pivotal speech at the Jackson Hole Symposium on Friday, August 23, 2025. With his term set to expire in May 2026, this could be his final major address as Fed chair, a moment that will test his ability to balance conflicting demands and maintain the Fed's hard-won independence. The forces at play: Trump's ultimatum versus economic headwinds. President Donald Trump has made it clear. He wants Powell to resign and to slash interest rates immediately. The president points to strong GDP growth and subdued inflation as justification. But Powell has resisted these calls, insisting the Fed is taking a wait-and-see approach. However, the economic landscape is anything but simple. Recent data reveals a slowdown in job growth, and a key inflation measure, the Producer Price Index, just hit its largest annual increase in 3 years. This creates a paradox. Lower rates could boost employment, but risk reigniting inflation, while holding rates risks stifling job creation. But here's where it gets controversial. Trump's public attacks on the Labor Department, after it fired its head of labor statistics following a disappointing jobs report, have cast doubt on the reliability of economic data. Critics argue this undermines the Fed's ability to make informed decisions. If the data itself is questioned, how can the Fed act with confidence? This is the part most people miss. The Fed's credibility hinges on its perceived independence from political interference, and Trump's actions are testing that very foundation. The dual mandate dilemma: jobs versus prices. The Fed's dual mandate, to maximize employment and stabilize prices, has never felt more at odds. Lowering interest rates typically stimulates hiring, but can fuel inflation, while raising rates does the opposite. Today, the Fed is stuck in a pickle. Recent job growth has weakened, yet inflation shows signs of creeping upward. This raises a critical question. Should the Fed prioritize one goal over the other, or risk both? As Will Denyer of Gavacal Research notes, data alone suggests a rising risk of stagflation, a Fed nightmare. That puts them in a bind between their two mandates being in conflict. Jackson Hole, a stage for strategy or a minefield of expectations. The Jackson Hole Symposium, hosted by the Federal Reserve Bank of Kansas City, has long been a platform for the Fed to signal its policy direction. Yet Powell is expected to tread carefully. Fed officials typically avoid hinting at monetary decisions before official announcements to prevent market volatility and shield the central bank from political pressure. Still, investors are betting heavily on a September rate cut. Wall Street analysts give the Fed an 88% chance of lowering rates by 0.25 percentage points, according to FactSet. But as Mike Sanders of Madison Investments warns, Powell can't commit to a cut because that leaves him no room to maneuver. He has to signal, we're still data dependent. Otherwise, the Fed risks being cornered into a decision it later regrets. All right, the clock is ticking before the September 17 rate decision. The Fed will review two critical reports: the Labor Department's August jobs data, scheduled for September 5th, and the Consumer Price Index, September 11th. These figures could sway the Fed's decision. However, the controversy over the Labor Department's leadership, after Trump dismissed its top statistician, adds another layer of uncertainty. If the public questions the accuracy of these reports, the Fed's credibility could suffer too. What's next for the Fed, and for you? As Powell delivers his speech, the world will be watching for subtle clues about the Fed's next move. But the bigger question is this: can the Fed remain independent in an era of intense political scrutiny? Or is the central bank's role as an impartial arbiter of economic policy now at risk? Share your thoughts. Do you think the Fed should prioritize inflation control over job growth, or vice versa? And how much should political leaders influence monetary policy? Let's discuss in the comments below.